With this, we come towards the end of the second unit of Applied Corporate Finance, and this we are going to kind of consider an extension of what we have already discussed around the two or three areas around cost of equity, risk-free rate, and equity risk premium. We do have the entire cost of equity equation available with us. We are now going to try that out and then extend that in terms of what is known as the cost of capital for the firm. So if we were to introduce the cost of debt into the equation and we were to go and calculate what is going to be the total cost of capital for a firm. So cost of capital for a firm should be a function of cost of equity and cost of debt, some function of these two, right? We are going to introduce what function that is going to be and how are we going to look at that, right? Let's kind of go ahead and first understand what do we mean by the hurdle rate. We revisit our discussion around that. We have the relevant components. We can now look at calculating the hurdle rate, which is the cost of equity, right? How would you calculate the cost of equity? You have risk-free rate, you have beta, and you have the equity risk premium, which is RM minus RF, right? Now we have identified risk-free rate to be 5%. We have identified this number to be about 8%. All we need to do is get the stock specific beta and calculate the number, correct? Let's try that out. Let's try and calculate it for SBI, Infosys, Tata Steel, NTPC, and HUL from the table above, right? So let's take them one by one. Remember, in all these cases, RF is equals to 5% and equity risk premium is equals to 8%. The only parameter that is different from for all these stocks is the amount of risk each of these stocks add to a completely diversified portfolio, and that is what we mean by beta of that stock, right? So let's look at SBI. Where is SBI? Here is SBI, beta of 1.56. So what does the equation become? That's 5 plus 1.56 into 8%. That's going to be the beta for cost of equity for SBI, right? So for SBI, we can write it as 5 plus 1.56 into 8%, 5% plus 1.56 into 8%. This will work out to approximately somewhere around 17% to 17.5%, approximately somewhere in between these. That's what we have for SBI, right? Let's look at Infosys now. Infosys is 0.84, right? So if I were to calculate for Infosys, that's going to be 5% plus 0.84 into 8%. That's going to be approximately equal to 8 into 8 is 64. So this should be 6.5% or something. That should work out to 11.5% for Infosys. Tata Steel, where is Tata Steel? That's here. That's 1.73, even bigger. 5 plus 1.7 into 8%, right? 1.7 into 8% would typically be close to 17 times 8, that's going to be 12.6%. So effectively the number here would be 17.6% or so, right? 5 plus that number, right? So effectively sorry, that's going to be 5 plus 13, so that's going to be 18.6% for Tata Steel. So Tata Steel works out to 18.6%. NTPC is here, that's 0.9, so 0.9 into 8% will be 7.2. 7.2 plus 5 is going to be 12.2%, and HUL would probably have the least beta. That's because it's almost 0.5 here. That's HUL, Hindustan Unilever. So 0.5 into 8 is 4 and 9%, somewhere around 9%. Now what does it tell us? I'll just write the numbers here and I'll write about 17% here. When you are investing in any of these stocks, this cost of equity gives you effectively the rate at which this stock will be able to raise money, or this company will be able to raise money. And in a way, this is the amount of return you as an investor should be expecting when you're investing in this. So if you're investing in SBI, you would want 17% return. Infosys, because the risk perceived is lower, you're okay with 11.5. Tata Steel risk perceived is higher, you want 18.6%. NTPC 12.2. HUL is considered as the least risky in all these. Why? It's because it's an FMCG stock, no debt, steady demand, consumer demand related stock. So the industry characteristics say that if you get 9.5, 10% return from HUL, you should typically be happy with your returns that come out of HUL. That's how you calculate the cost of equity, and that's what is the significance of this number when you look at it. I'd urge you to try out some of the other ones as well as we go along. Now we move to the cost of capital argument. So far we were looking at if the firm had to raise money from equity holders, what is the kind of return they will expect? Remember, the return that an equity holder expects, the return expected by investors is nothing but cost for the company, right? So cost of equity is going to be the return expected by the investor, which we just found, right? The same argument will play out for cost of capital as well. But now, instead of only equity holders, we are going to look at all other stakeholders as well. And that is where this is going to bring in the cost of debt for us, right? Now, we need to take some sort of weights into account. So we are going to take the weighted average of cost of equity and cost of debt. So there are two inputs into this. We've already calculated cost of equity. We now need to turn our attention to what should be cost of debt for a firm. And then we need to find out what should be the weights we are using in calculating this cost of capital, right? Let's understand the cost of debt. There are various methods of calculating this, right? The first one could be firms may have directly specified this in the annual report in the notes to account section. So when you look at the financial statements, at the end of the financial statements, there are notes that are there. You could look at those notes and you can try and find out if the company sometimes specify there very clearly that, 11.5% or 12% kind of loan that the company has taken. So that's available there. Second, if the company's bonds are trading in the market, right? Just like Government of India bond trades in the market, we know what the yield is. That gets taken as the risk-free yield effectively. We can take the yield to maturity of these company bonds if they're trading and take that as cost of debt. So let's say Tata Motors issues a 8% bond that pays you 108 at the end of 1 year. This, if it is trading now at 99, effectively the rate of interest, the yield would be 9%, 9% YTM, right? That's going to be your cost of debt. If they're raising money today, they will have to pay 9%, or the investor is expecting 9% in this company's debt, right? That's the second one. Third, if the company's bonds are not trading, which is most likely to be the case in India, you could look at the credit rating and compare the yields of similar rated bonds in the market. So if the company's rating is AA based on the parameters it has, you could look at that and then go and see if there is a AA rated bond trading in the market, and you could compare the yield on these things. And finally, if none of the above are available, you could just take the interest that the company has paid and divide that by the loans and do it for multiple years. So year 1, year 2, interest by loans, right? And then basically take the average of all of these. Total interest divided by total loans outstanding. It's always a good idea to do it across multiple years and then take an average, because otherwise it might distort the results you get from only 1 year of results. And one of the years maybe the interest cost was paid lesser or something. That doesn't distort your overall understanding of the picture. So that's what cost of debt should be, and that's how you calculate cost of debt. Now there's one final adjustment to this still. Some companies have international debt. Now remember that cost of debt has to be in the same currency as the cash flows. So if you borrow money at 4% in the US, your interest cost will appear significantly lower. That's not true. So this needs to get converted into local currency. So there's this equation called interest rate parity, which we remember from this thing, that cost of debt in India is going to be a function of inflation in India, right? Interest rates in India are 8%, 7%. US, they are 2%. Why is the difference? Is because inflation is lower in the US as compared to India. So equation wise, cost of debt in India would be directly proportional to the inflation in India, correct? So you use this equation. Now if the cost of debt in US is 4%, inflation in India is 6, and that in the US is 4, can we find and back calculate the cost of debt of India? Right? So we replace the numbers in this equation, 1 plus cost of debt India, 1 plus US cost of debt, etc. And now when you multiply this, this would give the total cost of debt in India as 8.1%, right? Which is very close to where you would arrive even if you were to directly look at bond trading in the Indian market. If I was to ask you offhand, what do you think should be the cost of debt in India? Then because you're happy with 10-12% kind of return with stocks like Infosys, with debt you should be okay with slightly lesser than that, 8-9%, right? And that's your 8-9% that's coming through this equation as well. So it's not like hypothetical numbers that we're using. Broadly, you will end up with a number that anyway the market would look at. Always remember that if you see an interest rate or cost of debt for a company that is less than 6 to 7%, you should try and investigate more. Remember, Government of India borrows money at about 7.5%. So it is unlikely that any company can be able to borrow money at a rate lesser than that, right? Why is that? Is because government is considered risk-free. Why are they considered risk-free? Is because they can print money. Companies cannot, right? Companies cannot print money, and so they should be getting paying a bigger rate for raising money, right? So 8% is what we get. Now we go to what is called as the weighted average cost of capital. So effectively, weight of equity into cost of equity plus weight of debt into cost of debt. That should give me my cost of capital, right? Now what do we do is, that's fine, but how do we calculate weight of equity? So what is the total value of money in the firm? That's equity plus debt. So if I take equity by equity plus debt, that's weight of equity. And if I replace that by total value, then E by V is going to be the weight of equity into cost of equity. That's RE. D by V is nothing but D by E plus D. And that's going to be D by V. That's weight of debt into cost of debt. Remember, cost of debt gives you an interest tax shield. So that needs to come here, 1 minus t. And once this comes here, 1 minus t, the equation that we get is what is the weighted average cost of capital, WACC. So if you are trying to find out what is the average return that any stakeholder would expect while investing in this firm's stock or bonds, this is the answer, which is weighted average cost of capital, right? Now that brings us to the next question. When we write E and E plus D, where do we get these values from? Is this from the balance sheet? Remember, balance sheet values are also called as book values because they're coming from book value of account. Or should we get the market values? Right? Because market value of equity is available. The stock is trading in the market, so you can use what is called as the market capitalization, correct? So what weights do we use? This is a common debate that we should use equity and whether we should use book values or market values. The values used should be market values for multiple reasons. Why market values are better? Point one, it reflects today's business environment. If a company raises equity today, it is going to be closer than the market value than the book value. If the company stock is trading at 100 rupees and the book value is 20 rupees, remember book value of equity. So book value of equity is nothing but share capital plus reserves and surplus, all the undistributed income that the company has so far, right? That's the book value of equity. Market value of equity, on the other hand, is what is the share price into number of shares that the company has. The two could be completely different, and usually because book value is only historical looking, book value is what the company has done till date. So if you're looking at the book value of the company, if you're standing here in a particular year, all that the company has done in the history is going to be here in share capital and reserve and surplus. That's book value. All that the company is going to do in the future is going to be in the market price. So market price is history plus future, and hence it should be book value plus something, unless you believe that the company will destroy value. So usually market value should be higher than the book value. That's the broad premise we all work on, right? Now, hence it is always good to use market value better than book value. Then generally people believe that using book values is conservative. That's not true, right? Now we can safely say that book value of equity is less than market value of equity, right? For all firms. So when you have market value of equity that is higher, if you're using market value of equity, then equity by weight will be higher. The total value, the weight of equity will be higher, or in other words, WE would be higher if you are using market value of equity, right? If weight of equity is higher, then WE into cost of equity will be bigger. And we already know that CE is greater than CD. Cost of equity will always be greater than cost of debt. So if you are increasing the weight of equity, which will most likely happen if you are using the market values, then you are in a sense increasing the value for weighted average cost of capital. When you increase the value of weighted average cost of capital, the estimate you get is going to be more conservative if you use market values, because remember, you are discounting your cash flow by a rate R. If R is higher, which will happen if you're using market values, if R is higher, the value of the discounted cash flow will be lower, right? That's what we need to understand. That contrary to understanding, and in fact, if you use book value, the value of R will be higher, will be lower, and that will give you a more aggressive estimate of the value if you use the book value to get a lower WACC. Correct? So always use market values. And finally, it's assumed that market value is more volatile and hence more prone to error, because the markets are volatile, stock markets are volatile. But it is this volatility that is extremely useful while analyzing companies. Now imagine a company's management gets arrested in a certain case. Is that bad or good for the company? Does that impact what happens to the company in the future? The market value will immediately reflect it. The book value will not, right? So technically, when we use E and D, we should be using market values. Now, typically, the book value of debt is considered approximately same as the market value of debt. So what happens is you can use the market value of equity, and because this is the same, you could use the book value of debt, which is available in the balance sheet. Most of the times this approximation works absolutely fine, right? Let's calculate WACC for Tata Steel given the data in the table earlier. We already calculated that for Tata Steel about 18.5% would be the cost of equity, correct? Assume market value of equity for this firm to be 30,000 crore, debt as 70,000 crore. So what is weight of equity? That's 30%. How do we get that? 30,000 divided by 30,000 plus 70,000. Total value is that much. And consequently, weight of debt would be 70%. Cost of debt is 10%. And tax rate is 30%. What is the equation? 30% into 18.5% plus 70% into 10% into 1 minus 30%. In other words, 30% into 8.5 will be 1.85 times 3, which would be effectively, if I calculate that, effectively around 5.5%. And 70 into 10 into 1 minus 30 is 70 into 7%, that's 4.9%. So what we're going to get is somewhere around 10.4%. That is going to be the weighted average cost of capital for Tata Steel, right? That's how you basically calculate the weighted average cost of capital. Choosing a hurdle rate, we are now finally reaching a point where we have to choose a hurdle rate. The simple logic is, if you're evaluating the value of equity of the firm, use cost of equity as the hurdle rate. If you're evaluating the value of total shareholders of a firm, then we use cost of capital as the hurdle rate. Fine, that's broadly it. As we come to the end of this particular unit and this particular video, a couple of questions. Explain whether we should use market weights of equity or debt or book values of equity and debt while calculating WACC and why. And calculate the weighted average cost of capital for SpiceJet given this data. Beta of 1.45, risk-free rate of 5%, equity risk premium 8%, pre-tax cost of debt 10%, tax rate 30%, debt and equity of 2,000 and 4,000 crore respectively. Thank you.